Are you tired of watching your investments barely inching forward? Do you dream of discovering that one stock that could skyrocket and turn your portfolio into a goldmine? Well, you're not alone. As a beginner investor, identifying multi-bagger stocks might seem like a daunting task. But fear not, because in this video, we will share with you 6 proven strategies that could help you pick the next big winner. So, grab a pen and paper and let's get started. A multi-bagger stock is a stock that has returned multiples of its investment cost. For example, if an investment purchased for $10,000 increases in value to $50,000, it is said to be a 5-bagger, or it has increased by 5 times its investment cost. Another way to put it, we are looking for stocks that can achieve exponential growth. To achieve exponential growth, we need to find outstanding businesses which have great growth prospects and are trading at a price well below their intrinsic value. Buying great businesses below their intrinsic value not only provides investors with a margin of safety in case things don't go to plan, but also the potential for the stock price to increase as the market eventually recognizes the company's true value. Without any further ado, let's count down the 6 ways to find multi-bagger stocks. Number 6. Buy smaller and less well-known stocks. Investing in stocks of smaller and less well-known companies can often yield significantly higher returns compared to those of large, established firms. When a company starts with a small base, even a modest increase in business can result in a high percentage growth. In contrast, as a company grows, it becomes increasingly challenging to maintain the same rate of growth due to the law of large numbers. Smaller companies are typically in their early stages of their development and thus have more opportunities to capture a share in new markets or niches that are not yet dominated by larger companies. They can be more focused in their area of expertise and their senior management closer to customers, leading to greater customer satisfaction and revenue growth. Since smaller companies have fewer bureaucratic layers, they can be more agile and respond quickly to changes in market conditions or emerging trends, allowing them to take advantage of growth opportunities. Smaller companies are often overlooked by institutional investors, as they generally have restrictions on the types of stocks that they can invest in. For example, index funds and ETFs can only invest when companies reach a market capitalization that allows them into relevant indices. This can create a situation where smaller companies are undervalued. When investing relatively small amounts of money, there is a larger pool of growth opportunities. In contrast, large companies need to invest large amounts to effectively move the needle, which limits the number of deals available. Number 5. Companies with unique products. Companies with unique products have a distinct advantage when it comes to achieving revenue growth and high margins, which allows them to outperform competitors over the long run. These companies are often pioneers in their respective fields, and their products may be patented or have proprietary technology. This allows for a loyal customer base and the ability to charge a premium for their products. Having a unique product allows a company to target a specific niche market. By catering to the specialized needs and preferences of a particular consumer segment, these companies can charge premium prices for their offerings. Operating in a niche market also means less competition, allowing the company to capture a larger market share. Companies with unique products can create a strong brand identity that sets them apart from competitors. A powerful brand not only enhances the perceived value of the product, but also creates a sense of trust and loyalty among customers. This helps to drive repeat business and act as a barrier to entry for competitors. Furthermore, companies with unique products can capitalize on strategic partnerships. By collaborating with complementary businesses, they can access new customer segments, expand their distribution networks, and improve their product offerings. Companies with unique products may be acquisition targets for larger companies. As companies with unique products gain market share and become more successful, they may attract the attention of larger companies looking to expand their product offerings. Number 4. Quality management. The importance of capable management in a company cannot be understated, especially in smaller companies. Quality leaders possess a clear strategic vision, ensuring that the company remains focused on achieving its objectives. These leaders can identify growth opportunities and allocate resources effectively, enabling the company to expand its market presence, enter new markets, or develop innovative products and services, leading to long-term growth and shareholder value creation. Effective management teams can streamline operations, leading to increased efficiency and reduced expenses. By focusing on operational excellence, quality management can improve the company's profit margins. Quality management teams recognize the importance of attracting, retaining, and developing top talent. They create a positive work environment that fosters employee engagement and innovation. Companies with quality management can quickly adapt to changing market conditions and respond effectively to challenges and disruptions. These leaders can pivot the company's strategy, products, or services to capitalize on new opportunities or address emerging threats, ensuring the business remains resilient and well-positioned for long-term growth. In smaller companies, management may have a more significant personal stake in the business success. This personal investment can drive a higher level of dedication and commitment to the company's growth and profitability, which can ultimately translate into superior stock performance. Companies with strong management teams often have a better track record of financial performance and have a clear strategy for growth and a disciplined approach to capital allocation. This makes them more attractive to potential acquirers. If you're enjoying this video and finding our tips valuable, don't forget to hit that like button and subscribe to our channel. Not only will you stay updated on our latest investing advice, but we also have a special bonus tip for you at the end of this video that you won't want to miss. So, stick around to discover even more insights to supercharge your investment portfolio. Now, let's dive back into our guide and explore the next 3 strategies for identifying multibagger stocks. Number 3. Buying excellent businesses at the bottom of a bear market. Purchasing stocks at the bottom of a bear market can be an attractive investment strategy for those seeking outsized returns. While investing in a bear market can be challenging and fraught with uncertainty, those who are able to identify opportunities at the bottom of the market cycle can potentially reap significant rewards. During a bear market, stocks are often broadly sold, leading to lower prices. As a result, there are opportunities to acquire shares of excellent businesses at huge discounts to their intrinsic value. For example, during the financial crisis of 2007, it was possible to purchase stocks of companies that had market capitalizations less than the cash they had in their bank accounts. Buying stocks at the bottom of a bear market often requires a contrarian mindset, as it entails going against prevailing market sentiment. While many investors may be selling out of fear or panic, those who are able to maintain a long-term perspective and capitalize on market inefficiencies can achieve superior returns. By being selective and focusing on high-quality companies with strong fundamentals, contrarian investors can achieve exponential returns when the market eventually rebounds. The surest way for a company to become really big is for it to dominate a market early and then wait for that market to multiply in size. A bear market is a great opportunity to evaluate the future market for a company's niche. This is because in a period of depressed prices, very little if any of the future growth is factored into companies' share prices. Number 2. High revenue growth plus a high cost of sales margin. Ultimately, future earnings growth is what creates shareholder value, but you will likely have to invest before the company is even profitable. As such, revenue growth is a key metric in evaluating companies with exponential growth potential. Companies with high revenue growth often have a strong competitive advantage, enabling them to capture a larger share of the market. This is frequently driven by innovation and the development of new products or services that address unmet customer needs. High-growth companies can create a compounding effect, whereby it continues to grow its revenue. The earnings generated can be reinvested to fuel further growth, creating a virtuous cycle of expansion and value creation. Companies with strong revenue growth are often better equipped to withstand economic downturns and market volatility. Companies with high cost of sales margins have a strong foundation for generating profits, as they are able to generate more revenue per dollar spent on direct costs. As revenue grows, these companies can benefit from economies of scale, leading to improved operational efficiency and even higher profit margins. Ultimately, for a stock to be a multi-bagger investment, the company has to consistently grow its earnings at a high rate without deteriorating its profit margins, indicating that the company is not booking low margin or negative margin orders for obtaining sales growth. I generally look for a company with sales and profit growth of over 20% year-on-year. Number 1. High return on equity and low debt-to-equity ratios. Return on equity is a financial metric that measures a company's ability to generate profits relative to the equity capital invested by shareholders. A high return on equity indicates that a company is using its shareholders' capital to generate profits in an efficient manner. A high return on equity often indicates that the company has a sustainable competitive advantage in its industry, which allows it to generate higher profits than its competitors and can maintain this high return on equity year after year. Companies with high return on equity are effective at allocating capital and generating profits from their investments. This efficient capital allocation can lead to a compounding effect of higher earnings per share and a higher stock price. It is common that companies with a high return on equity pay lower dividends, as they tend to have opportunities to reinvest their earnings back into the business to fund growth initiatives or improve operational efficiency. However, it is important to note that return on equity does not account for the company's debt. By considering the debt-to-equity ratio alongside return on equity, investors can gain a more comprehensive understanding of a company's financial health and performance. A high debt-to-equity ratio indicates that a company is using a significant amount of debt relative to its equity to finance its operations. While leveraging debt can boost return on equity by increasing the company's assets and potential returns, it also increases financial risk. A company with a low debt-to-equity ratio and a high return on equity suggests that the firm is generating strong returns without relying heavily on debt. This can indicate a more stable and financially healthy company that is less vulnerable to economic downturns or changes in interest rates. I would prefer stocks with a return on equity of greater than 25% and a debt-to-equity less than 0.7. Bonus tip: growing cash flows from operations. Cash flow from operations is a key financial metric that measures the cash generated by a company's core business activities. A strong cash flow from operations indicates that a company is generating significant cash from its core business. A healthy cash flow from operations indicates that a company is better equipped to weather economic downturns and market volatility. The robust cash generation provides a solid foundation for continued investment in growth initiatives, even when the broader market is struggling. This resilience can make such companies attractive investments for long-term investors seeking capital appreciation and financial stability. Companies that consistently generate strong cash flows from their core operations are often well-positioned to fund future expansion and capitalize on market opportunities without relying on external financing. These companies often possess a competitive advantage in their industry, such as proprietary technology, a strong brand, or a dominant market position. This advantage allows them to maintain or increase their market share, leading to continued growth and long-term success. Multibagger stocks seldom look like a sure thing. Often the companies are controversial in some way and there will be a large element of uncertainty. Some market analysts may question the business model and predict failure. It's best to invest in a portfolio of potential multibaggers if you hope to end up with 2 or 3 successful picks. Having a modest initial investment in each company should protect the portfolio in the circumstance of failure of one or more investments. Your successful picks will still go on to be large positions in your portfolio. And there you have it, folks. We've covered 7 key strategies to help you identify potential multibagger stocks and set yourself up for success in the world of investing. Remember, picking winning stocks isn't always easy, but by applying these principles and doing thorough research, you can significantly improve your chances of finding those hidden gems. If you found this video helpful and want to learn more about investing, stock analysis, and personal finance, don't forget to hit the like button and subscribe to our channel. Your support helps us create more content to empower beginner investors to make informed decisions and achieve financial success. Also, if you have any questions, thoughts, or personal experiences with multibagger stocks, feel free to share them in the comments section below. We love hearing from you and learning from your insights. And who knows, your story might just inspire someone else to embark on their own journey to financial freedom.